Welcome back, investors, to Ticker Time News. I'm Adam. Thank you for joining me for the After Hours show. I am great to be here with you. I'm glad to be here with you. I'm excited to be here with you, and I hope you are too. We've got a bunch of things to talk about, like we do every day after the market has closed. Look at this nice 2-day bounce in the market. I hear a lot of analysts talking about, is this a dead cat bounce? Now, it's got nothing to do with an actual cat. It's a technical term for a market that is headed down, but we get this jolt of energy, right? And we have these couple of days of nice gains, nice green area. It's no longer selling into strength, but it's buying the dip, and we have a nice rally, and then it just wipes out. It just completely turns over on its head and falls and continues to fall down lower. So, are we witnessing a dead cat bounce right now in the markets? And is February, since this is the last trading day of the month, is February, which starts tomorrow, what is that month going to be? Since January was the worst month for trading since March of 2020, which is pretty bad. Will this downtrend continue? And are we seeing a dead cat bounce? That's the interesting thing to watch. Now, it's been great. The past two sessions have been absolutely awesome, and totally glad for them. But I do, hold on, make a quick adjustment here. We're live streaming, so there's always something that pops up that we're not expecting, just like in every live stream. Just like yesterday, every live stream, there's always one thing that catches me that I wasn't quite prepared for or didn't adjust beforehand. All right, so now that's out of the way. Let me get back to this. When investing, it's best to stay invested and think long term in the market, because you never know when the market might turn around. And the past two sessions have been green. I mean, we can obviously see on the chart, clear as day, how bad January was. I mean, we're nowhere close to where we were when we started the month, even though we've had 2 days of great gains. So, you can't always second guess yourself when you're in the market, and it's always best to just stay in the market. Even with a bear market, right? You are still adding to your position over time. And it's better to, in this instant, when the market is going down, it's better to buy on those red days to lower your cost basis. So when the market does get back into rally mode, you're better off. Your cost basis is lower and you are better off as an investor. Now, getting nervous and selling out of the market because it's going down, that can work out for you, but nobody is perfectly able to time the market. We've all got 2020 in hindsight. We can all see, oh, I should have bought the dip when the S&P fell to nearly 4,200 right here on January the 24th. That long wick that comes almost down to this blue line here at 4,200. It almost got there. It was 22 points away from that line. Should have bought the dip there. That would have been perfect, right? But it's okay. Nobody can time the market. And that's what I'm trying to say. It's okay. But it's better to be in the market than not in the market and miss out, or sell out of the market only to buy in at a higher price. That just doesn't make sense. It's like buying Tesla last year for $550 when it got that low, but then selling it at $900 or $800 like it fell last week, only to buy back in the 900s like it was in today. So you never know when that turnaround is going to happen. And if you're a long-term investor, if you're looking at this as, I'm putting money away for the future, I'm putting money away for retirement, I'm putting money away for the next 5 years, 10 years, 2 decades, it's always better to be in the market. Now, of course, there are instances where you can look at, the S&P 500, or better yet, the Nasdaq and the tech bubble that we had in 2000. It took over a decade. If you bought in at the top of the at the Nasdaq during the dot-com age, March of 2000 is when the bubble bursts, right? And if you would have bought in at the top or near the top of March 2000, it took over a decade for the Nasdaq to get back to that level. So there are instances, yes, but if you're investing long-term, and I'm not talking about trading here, I'm talking about long-term investors, it's better to stay in the market. So what a refreshing reminder that is, when you buy when the market is red and you watch for your returns to grow over time. Okay, now just as we have had these 2 sessions of beautiful rallies, the stock market did close sharply higher on this as the last trading day of January. It was led by gains in consumer discretionary, communication services, and of course, tech. On the month, the 3 main indices, they managed to erase some losses, but they still booked big declines amid mixed earnings reports and the Fed that moved to a more hawkish monetary policy, with investors increasingly betting on 4, maybe I've even heard people talk about 5 rate hikes in 2022. I find that incredible to even talk about 5 rate hikes. Man, it's got to be pretty bad with inflation for the Fed to do that. All right, Eevee Stocks today, they took off, and really, like, some names that we haven't heard in a while. Lordstown Motors, ticker symbol RIDE, RIDE. It has probably been a year and a half since I have mentioned Lordstown Motors in any vehicle, and you can see why. I mean, this thing has just been dropping, and it has dropped hard. And Workhorse too. It's been a while since I've talked about, months since I've talked about Workhorse. And that was when I followed very closely, especially with the whole UPS issue that it had. But look at Lordstown Motors on the right-hand side of the screen, up 22.4% during regular session. And it's up 1.6% in after hours. That's just incredible. And then look at Workhorse. WKHS is the ticker symbol for Workhorse. Look at this rally. 16.5% it is, and it's loading 16.5% for Workhorse. That is just crazy. Yeah, and you see all the lines I have here on the chart for Workhorse. It's one that I followed very closely early on. But yeah, man, yeah, all of them. And then Tesla, TSLA, is the ticker symbol, and this is all on TradingView, and there is a link in the description for a free account to TradingView. It's where we do all of our charting. All the charts you see on any of our videos, it's always from TradingView. We use them exclusively. I find it to be one of the best platforms. But look at Tesla, 10.6% today. The electronic vehicle, or EV space, it's just took off today in a big explosion. And if we zoom in here on Tesla, okay, Tesla had big earnings and they were talking big about the future, but there's this trend line right here for Tesla that it dipped below on the 27th of January, and it got even lower below that 200-day moving average, and then it just popped this big gap up today in this 10% rally in Tesla. So I ask you, what fundamentals in these companies, Lordstown Motors, Workhorse, and even Tesla, what changed in their fundamentals today to cause the stock to rally so far, especially Lordstown and Workhorse? I think you know the answer. Nothing, right? This was just a rally that we had, minus Tesla. Tesla definitely has some interesting things happening, but nothing changed significantly today with the not the valuation, with the fundamentals of these three companies to warrant such a big rally. So all I say is do be careful, because this week, NIO, Li Auto, Xpeng, they report their delivery numbers this week for December. And those delivery numbers may not be as high as some may hope. Look at NIO. NIO is the ticker symbol for NIO. And the reason that the delivery numbers may not be as high is because China did have a lot of restrictions in their country due to the Omicron variant. And that could have put a strain on deliveries and even production. So, NIO 17.2% today. It is flat in after hours. It has not changed. 24.51 a share. Now, that's a great bounce. I mean, RSI for this, and I started talking more about the relative strength index, especially in last night's Catalyst Watch video, that if you haven't watched that, I would, after this live stream, I would watch it to see what's going on in the market this week. But the RSI, since we have been selling down in the market for the majority of the month of January, the majority of the days were red. Probably a handful of days, literally, were green. So with that significant pullback, especially in small caps and growth companies, EV startup like NIO is definitely one of them. With such a tremendous pullback just this month alone, the relative strength index becomes ever more important, because you can identify potential bottoms, or at least short-term bottoms. If you look at NIO here, their RSI on Friday was at a 20.6. 20.6. 30 and below is oversold. So it was oversold. And then you look historically, okay, whenever NIO gets down to this level on the RSI, what happens? Does the stock rally? Does it bounce? What happens? And NIO hardly ever gets that low. It hardly ever gets below 20. And if you look back in history, we can go back here to December 17th. It was a 23, not quite a 20. We can go back here to December 6th. It was again a 27, not a 20. Let's go back to this low point. My head's blocking it, but it's on August 19th. It's a 28. So never in the past few months has NIO been below 20 on the relative strength index. So what does that do? That shows investors that now is a good opportunity to buy the dip. And that could be where Friday's rally and today's rally came from. An oversold market, which can very easily become an overbought market. Or it can very easily, and I don't want to sound too fuddish, fear, uncertainty, and doubt, or too bearish, just trying to be a realist. Because that's what investors are, realists. Okay. When you see a market that has been going down and down and down, and look at NIO stock. Let me adjust the chart here. And again, this is the daily view, so each candle represents one day. As we get further out on the chart here, you can see that NIO is down significantly from its highs. And you could show me the reverse argument that it is way off its lows as well. It's probably sitting in the middle between its lows and its highs. But a market that's been coming down, and especially individual stocks that have been coming down, small caps and growth stocks, they typically come down. They're exaggerated, okay? And the reason I say why they're exaggerated is because on down days, they usually perform worse. On up days, they usually perform better than the indices. So, with this bounce after such a decline, the RSI got to a reading that was so low that investors decided, hey, now's a good time to buy the dip. And I think it was more traders than investors buying this dip Friday, running into today, getting our nice rally, our nice 2-session rally, just to sell it either tomorrow, Wednesday, Thursday, what day? Because I don't think it's going to last. I don't think so. Unfortunately, I don't believe February is going to be a strong month. January was not a strong month, and I don't think February is. I don't think we're going to get to sustained rallies or anything like that until after the Fed has came out with its decision in March. I think that's the real important date. Okay. I've been talking there a bunch. Let's look at some other places in the market today. And I also have to mention, though, real quick before we do, Rivian and Lucid, they also did well in the EV market today. All right, I got to put this in here. Knowing what the top 10 stocks are in categories like value, growth, dividend, and momentum provides investors just like you and me with the guidance needed to outperform this crazy market. So to help investors meet their goals in 2022, we've put together the top 10 value, growth, dividend, and momentum stocks lists. That's 40 high quality stocks ready to choose from that are constantly updated. So you always have the best names available. So click the first link in the description or the link in the live chat, become a member, and get instant access to our top 10 value, growth, dividend, and momentum stocks list, and so much more. We've done the research, so you don't have to. All right, let's talk about the market. Yeah. Before we do, I really have to mention this. It's been bugging me a little bit. Not bugging me. It's interesting. Let me put Microsoft up here. MSFT is the ticker symbol. The gaming industry, and I just want to talk about this just real quick. And then I want to talk about the earnings so far that we've seen and what it means for the market. The gaming industry seems to be shrinking. It seems to be shrinking. And not in the sense that people aren't buying these big names, these big games and these consoles and so forth. It's that these smaller firms are being bought up by bigger firms. Look at the news. Look at the news today. Sony has a definitive deal amounting to $3.6 billion to acquire indie game maker Bungie, a longtime partner that developed iconic hits including Halo and Destiny. Bungie will continue to operate independently in this deal. So the deal gets Sony access to Bungie's tech expertise, and particularly its approach to live game services. Bungie's currently focused on the long-term development of Destiny 2 and expanding the Destiny universe. The Halo franchise, which, by the way, got its start on the Xbox made by Sony rival Microsoft, it was at the time considered a killer app for the first Xbox. And the franchise overall has sold more than 65 million games, with the game grossing close to $3.4 billion over that time, too. But Bungie split from Microsoft to establish itself as an independent developer in 2007. Independent. These independent houses seem to be coming back under the fold, but with different companies. Now, Microsoft did retain rights during that time to Halo and established a studio to oversee that franchise. On the Destiny side, Bungie bought an 8-year partnership with none other than Activision Blizzard to end in 2019, planning to acquire publishing rights and to put the series out on its own. Now, Microsoft, of course, recently announced its planned takeover of Activision Blizzard. This is all connected here, isn't it? So will Microsoft buy Electronic Arts next? The ticker symbol for Electronic Arts is EA. Now, I talked about EA in the Catalyst Watch video from yesterday evening. And something interesting happened today. No, it wasn't that the stock rallied 100%. No. The stock for Electronic Arts, it's been flat for over a year. I mean, just look at this sideways movement from it. A bottom of around 125, a top 150 is its all-time high, but really 145. But it's been moving sideways for a year while others are expanding. Well, long-term Microsoft, and this is where it's all kind of getting fascinating. Longtime Microsoft corporate VP and CFO of the Cloud plus AI group, Chris Shaw, was selected to be the new Chief Financial Officer at Electronic Arts. Now, I don't know, but the gaming industry, like I said, seems to be getting smaller with these big acquisitions. And I find the placement very interesting of EA's new CFO coming directly from Microsoft, being a VP at Microsoft, and being in leadership roles at Microsoft for over 25 years is now all of a sudden going to EA as the CFO. The Chief Financial Officer, the CFO, the one who would be right there with the CEO on working out a deal to be acquired. I find it fascinating and awful interesting. Does Microsoft have it in them to make two big gaming acquisitions in the same quarter or the same year? It is fascinating to me about this move with Chris Shaw. I believe that's how his name is pronounced. It's S-U-H. Maybe it's Shaw. I don't want to mispronounce it, and my apologies if I did. But I do find it interesting. I guess I'm theory crafting here, right, on this move. But it's interesting. So Sony makes a big move in the gaming industry. Microsoft just made a big move in the gaming industry. And now there's this shuffle of a Microsoft VP going to EA as the CFO. It's just fascinating. Okay, let's talk about earnings season because that's what I want to talk a little bit about. I'm going to go back to the S&P 500 here. The SPX is the ticker symbol I use in TradingView for the S&P 500. Now, earnings season so far. I want to talk about how it's going and what the results reported so far mean. So, Q4, good earnings, but positive surprise factors are not as good as earnings before. So Earnings Insight shows that following the Q4 reporting period so far, the S&P 500, 33% of companies have reported earnings so far. And 77% of those companies have exceeded consensus EPS estimates. That is below the one-year average, which is at 83%. But it is above the 5-year average of 76%. The blended EPS growth rate, which accounts for, or it's actual reported in estimates for companies that have not reported yet, is 24.3%. That would be 4 quarters with EPS growth above 20%. So the blended revenue growth rate right now sits at 13.9%, up from the projected 12.8% on December 31st. Companies altogether are reporting revenues 2.5% above estimates versus a 5-year average of 1.5%. So the blended net profit margin for the S&P 500, well, it sits at 12%, in which is above the 5-year average of 11%, but below Q3 net profit margin of 12.9%. In all, companies are beating consensus EPS estimates by about 4%, which is below the 5-year average of 8.6%. The EPS growth estimate for Q1, it's also slipped to 5.6% from 6.2% on December 17th. The forward 12-month PE ratio is 19.2 times, and that's down from 21.2 times, reported on December 17th. Now, the 5-year average is 18.5 times, and the 10-year average is actually 16.7 times. So what does this mean? I know I just threw out a bunch of percentages and a bunch of numbers. So let me boil this all down. Upward earnings momentum was a key source of support in last year's market. The S&P was up over 27% on the year. That momentum is fading, evidenced by the smaller beat rate for Q4 and the downward revisions to projected Q1 growth estimates. The slowing momentum is a key reason why market participants have become more selective about how much they are willing to pay for every dollar of earnings. That newfound perspective, which has been influenced by the rise of interest rates, has been a catalyst for the multiple compression and the shift towards favoring quality companies trading at more reasonable prices versus last year's approach of buying companies at just about any price. Again, this shows why our guides are so valuable. That's what I see. Investors are moving to quality, to companies that have a good balance sheet, that companies that are profitable, that companies that, heck, even pay a dividend. Investors, that's where they're going. And that's why I think this rally that we're in right now over the past 2 sessions is not sustainable. Growth is slowing. It is contracting. It is getting smaller. And again, like I started out in this live stream, I don't want to be over fearish, over bearish. I want to be realistic. So, just to plug it one more time, that's why we did create the top 10 list and value, growth, dividend, and momentum stocks. They're high quality names, and that's what it's there for, as a guide. All right, we're starting off the week to a great start from yesterday's Catalyst Watch video. And again, if you haven't watched it yet, I would highly recommend doing so after this live stream. And of course, our bonus ETF that we mentioned during yesterday's live stream It's doing good too, which was the Van Erik Semiconductor ETF. Ticker symbol is SMH. It was up 5.2% today. Now, the semiconductor sector, it's been hit really hard over the past couple of weeks. So the bounce is very nice. Now, on the bottom of your screen, you see this area underneath where the RSI is. And you see this green column, and there's a red column down there, and then some smaller green and red columns down there. This is the RSI, which is Relative Strength Index, and the MFI, which is the Money Flow Index. Basically, both of them are reading momentum. How much momentum is going into a very specific stock or an ETF or ETN, something new I learned, an ETN, or the general market, right? Momentum is key when you're trading, not necessarily when you're long-term investing, more so trading, because you want to buy at the best possible times. And those times are when momentum is weak. And you sell, like most of January has been, sell in the strength when momentum is rising. That's when you make the best profit. You get the biggest gain. So if we look at the Van Erik Semiconductor ETF, which is the semiconductor sector, it recently reached a low point for the RSI plus MFI. And that low point was right here on January the 25th, which wasn't quite the low for the ETF because the low actually came in on this longer wick on January 31st. I take that back. It was Friday, January 28th. The candles are too small. Couldn't quite see it. All right, there we go. On Friday, that's when it actually hit its lowest. So it's been in a buy box, is what I call it, for the RSI plus MFI. It's been in a buy box for a few sessions now, which means that momentum has hit the bottom. Hit the bottom. And when it gets to these lows, that's when traders start to pounce. Then, of course, the red boxes here, when it gets to highs, that's when traders, that's when they sell. So it did great today. So we mentioned that. And the reason we did is because there's some semiconductor earnings this week. There's over 100 companies in the S&P 500 reporting earnings this week. So it's a big chunk. So first up is Nxp Semiconductor. Now, the ticker symbol is NXPI. This is one that we mentioned in yesterday's Catalyst Watch video for today. They had earnings come out today, and the stock has reacted favorably. Big time. Oh, come on, load. It was up 8.4% today. Now, when its earnings came out, it was in this, again, because the semiconductor sector was at this momentum low on Thursday and Friday of last week. So that's when traders really stepped in to get this big rally. And then earnings came out and the stock, it went up. It went up. So 8.4%, that was a good call from our Catalyst Watch video yesterday. They reported their earnings EPS of $2.24 a share, and that beat by 15 cents on revenue of $3.04 billion, which was a 21.1% year-over-year gain, and that beat by $40 million. All right, next up we mentioned this on Friday of last week about Apple's earnings. And this is Serious Logic. The ticker symbol is CRUS. Now let them load there. They had earnings today, and I figured they would do great because Apple did great. And there's a strong connection between the two companies. Now, their earnings, the EPS came in at $2.54, which beat by 40 cents. Revenue came in at $548 million, and that was a 12.9% year-over-year gain. And that beat by $39.12 million. So the stock was up 4.9%, but here's the problem. In after hours today, it is down 7.3%. Why is it down so big in after hours after such a monstrous day of being up 4.9%, and especially off the back of what it was it up on Friday here? It was up 2.9% on Friday and a big gap up today, all because of Apple. But it got to guidance. It came down to guidance. Guidance didn't look so hot. So it's down, it's down 3.5%. I don't know where that 7% number came from. It's down 3.5%. Maybe I just read the percentage completely backwards. If I did, 3.5% drop in after hours. So not too terrible, but it's guidance that is moving the stock in a negative way. So nice rally, nice gain on earnings from Apple, and nice run from today's gain as well. And then selling that into earnings or holding it, you're still up. So that's a good one. All right, and then lastly, I mentioned Harmonic. Now, I'm not completely sold on Harmonic, and I said so in yesterday's Catalyst Watch video, but the ticker symbol is HLIT. Now, when they released their earnings, they had an EPS of 16 cents, which beat by 3 cents. And they had revenue of $155.8 million. And that was an 18.5% year-over-year gain. And that beat by $3.08 million. Now, the options market was pretty close on this one. The options market was anticipating a 14% swing, and the stock swung 10%. It is down 10% in after hours on this one. It did rally for the majority of the day. It was up 4.1% during the day, but after hours, 10%. And even though it beat, and this goes to show, I hope investors are listening and learning to this. This goes to show why guidance is so important. When a company comes out and beats on earnings, top and bottom line, they beat on EPS, they beat on revenue, but the stock goes down 10%, and that leaves a lot of new investors wondering, well, how did that happen? Well, it happened because of guidance. Remember, the market is nothing but what investors believe is going to happen in the future. And if the future is growing and the future is bright and looking good, then the stock will rise along with that. But if guidance comes in weak or down, then that doesn't look good for the company's future. All right. So there's those three from the Catalyst Watch video. Again, if you have some time, I would highly recommend watching that. Now, I want to talk about Walgreens here for just a moment. There was a report in Bloomberg that Walgreens Boots Alliance is what the full corporate company name is. WBA is the ticker symbol. But Walgreens may be dumping Boots from its name. Yeah. So, according to the Bloomberg article, Walgreens may be the company is, I don't know what the right word is here. The company is looking for a potential buyer to purchase its Boots UK segment. That's what it really comes down to. That's what the article really said. You can read the whole thing, but it comes down to Walgreens Boots Alliance, the corporation. You know, the Walgreens we have in US, Boots we have in the UK, right? So Walgreens wants to sell the UK segment, and they're looking for a buyer. But the stock was down 1.3% today. It's down nearly 0.5% in after hours. It's trapped in this downward spiral that has put it under its 50-day moving average and its 200-day moving average. At the moment, a possible suitor include private equity firm like Sycamore Partners, TDR Capital. Those could be buyers. But Walgreens is also considering spinning off Boots UK through an IPO if it cannot reach a favorable deal. And they're going to want a lot of money for this, a very high premium. Now, Bloomberg estimates that Boots UK could be worth $9.6 billion. Now, the timing of this sale might not get much better than right now. Walgreens' Boots segment, it delivered accelerated comp growth over the past 2 years, primarily on the pharmaceutical side. For example, Boots Pharmacy, its comps or comparisons jumped 8.8% in Q1 22, 2.5% in Q1 21, and 0.9% in Q1 2020. Meanwhile, due to COVID, Boots retail comps, they did lag over the same time frame, only seeing positive growth in Q1 22 of 16.3%. However, though, that must that most recent number, it is encouraging, as it may point to a robust recovery in foot traffic, even if it remains below pre-pandemic levels. Also, Walgreens is aggressively pursuing its primary care offering via Village MD, in which it made a massive $5.2 billion investment back in October of 2021, just a few months ago. It plans to open 600 Village MD locations by 2025 and 1,000 by 2027. By selling Boots, Walgreens could free up additional capital to accelerate those plans. And who else is focusing in that direction? None other than CVS Health. They said so last fall during their investment day. Additionally, Walgreens is trying to turn around Alliance RX, Walgreens specialty and home delivery pharmacy. Alliance RX is essential. It's essential to Walgreens specialty business, which does about $20 billion in annual sales, or roughly 15% of total fiscal 21 revenue. Walgreens recently stepped up its stake in Alliance RX2 to 100% from 55%, much to the frustration of investors, since Alliance RX is expected to experience an $8 billion decline in revenues in fiscal year 22. However, Offloading Boots UK could greatly assist Walgreens in restructuring Alliance RX. The last thing I want to bring up is with US sales covering over 80% of total revenue, selling Boots UK will enable Walgreens to focus more on growing its presence in the US, where it competes against two big players in retail pharmacy space. CVS Health, ticker symbol CVS, which posted another quarter of double-digit sales growth year over year earlier in this month, January, outshining Walgreens in the process. Meanwhile, Rite Aid, ticker symbol RAD, is in the midst of an aggressive turnaround, which is rad. So, why is the stock currently trading down today on the news of a possible Boots UK separation? Well, I think it primarily has to do with uncertainty. Uncertainty surrounding the possible terms of the deal. Boots International segment, mostly comprised of Boots UK, made up about 17% of total sales in fiscal year 22 of quarter one, making it a significant chunk of Walgreens' overall business. It is also the source of Walgreens' exposure to the UK, as it operates over 4,000 retail stores in the region. Shareholders will be anticipating a very high price tag for such an expensive overseas footprint. Overall, I think a possible sale of Boots UK would be a net benefit for Walgreens over the long run. The company is currently juggling multiple major investments, crucial to its long term plans and success. So, freeing up capital and focusing more heavily on those investments might be just what Walgreens needs to reverse its stock's lengthy downward trend. But let me know what you think in the comments below. Okay, Catalyst Watch to kick off February the 1st, my birthday month, by the way, is Exxon Mobil. Yes, XOM, Exxon Mobil. They had an announcement today that they are restructuring, they're moving their headquarters, and they're creating a, I forget exactly what it was called, something about the, oh, something about carbon. I can't remember what it is, but they're breaking off, creating a new segment within the company to really focus on bringing down their carbon footprint. So they have earnings coming up. This one I was split 50-50 on. So I've started to say my two Dow picks for the week in the Catalyst Watch video. And ExxonMobil was one that I was split 50-50 on. So I had one stock picked from the Dow 30. And I was split on what my second one would be. So I went 50-50 with ExxonMobil. And the reason I didn't go 100% with ExxonMobil is because its RSI is stretched right now. The stock has been on an incredible rally in January. It's up over 20% on the month. I think over 23% on the month. So it's had an incredible run. The oil and gas sector in general has had great rallies to start the year. So if you've been in oil and gas since January 1st, you've been doing really well. But ExxonMobil has earnings tomorrow, and they have an EPS estimate of $1.94 a share, with revenue of $85 billion, which makes it one of the world's largest energy companies. Yeah, I go into a little more detail in the Catalyst Watch video, but watch this one for earnings, but also be careful. Its relative strength is a bit stretched right now after its recent rally, But if you look at the grand scheme of things, from where Exxon Mobil has been in the past, there's another 10% that it could go before it hits any real resistance. And I go over that in the Catalyst Watch video. All right. The second one to watch for tomorrow, which I think has a more clear-cut path to winning the week, is Alphabet. Ticker symbol GOOG and GOOGL. Now, Alphabet, they report their earnings, and they have an estimated EPS of, wait for this number, $27.78 a share. Boy, does this company know how to earn a profit. And it's got revenue of $72.2 billion. So really what I'm watching here with Google is a gauge on the momentum of Alphabet's cloud platform, which is a component that has contributed greatly to the company's growth. So I'm really looking forward to that in their earnings tomorrow. And I think it could be a big win for the week, even if the market rally doesn't continue because of their good earnings report. But then again, if the earnings report is too good, that might make the Fed a little more hawkish. All right. I want to point something out here real quick before we move on to the next catalyst for tomorrow. And that is Google on the 25th. It triggered a buy alert when you're looking at the RSI plus MFI. Again, relative strength index plus the money flow index. It shows momentum, and it hit a low not seen in a year. That's right. Momentum hit a low not seen in a year on the RSI plus MFI, and it triggered a buy alert. Really cool. And that just so happened to be right here. There we go. 1 day after its bottom. And its bottom was right here the day before, which hit a low of 24.92. The very next day, boom, buy alert. That's why these, again, are so important to watch, because who knows where the stock's going after earnings tomorrow, quite frankly. But if you would have bought here at this low on the 25th when the buy alert was sent, right now you would be sitting with a 7.25% gain. That's why trading, it's so important to watch the technical indicators, because they can tell you a lot. All right. Next up, AMD. They also have earnings tomorrow. Ticker symbol AMD, and that stands for Advanced Micro Devices. Yep, I messed it up 3 months ago when I talked about them. I forgot what the D meant, but anyways, RSI for them plus MFI also hit a several month low on the 25th, which again triggered a buy alert, although it didn't hit the bottom until on last Friday. And then it took off. Because remember, on Friday the market started in the red, but it ended in the green. And that was the kickoff to the rally. But AMD was up 8.5% today. That's a pretty big move. And that goes again into the Van Erik Semiconductor ETF, if you would rather take a basket of companies. All right, so AMD, they report earnings tomorrow with an estimated EPS of 76 cents a share with revenue of $4.5 billion. Definitely be interesting to see how they come in. And then we have one I am very excited about for earnings tomorrow, and that's PayPal. Ticker symbol is PYPL. Now, I am very close with PayPal and their movements over the past several months, especially look at this, especially December and that drag out knockdown that it had here back in November. We talked about PayPal nearly every day for a couple of weeks as it was falling. $200 seemed like a really good entry point at the time. And then it hung out in between this range with a low somewhere around 185, 180, and a top about 190 or so. And then it just fell off in January, as the whole rest of the market did. But even though it sold off here in January, the RSI and MFI did not reach the same low that it reached back here, where I've got these purple squiggly lines and purple circle. That's where the RSI and MFI actually hit their lowest. And then the stock moved sideways for a month or so before it fell even more, but not by too much. I mean, we're talking about lows. Well, I guess it did. What was the low here? $152 a share was its absolute lowest so far in January this year. And it also set a new 52-week low for PayPal. I added more over the past month to PayPal because I still think it can turn. Have the fundamentals of the company really changed that much for it to fall like this? I don't think so. And yesterday in the Catalyst Watch video, I was trying to explain a concept that I'm not sure if I got across in the best way possible. And that is using website data to track how many views a company is getting on their website. I mean, it's really good for retail companies, even fintech companies, because the more people who visit the website, well, that should translate into more sales, more transaction fees, more revenue, right? Well, PayPal's website traffic is up over 10% during this last quarter. So, with website traffic being up 10%, how is that going to move revenue for PayPal? I mean, Honey, which is a subsidiary of PayPal, its traffic, joinhoney.com, it's up over 20% this quarter alone. So I'm really tracking it this quarter to see how website traffic can correlate to increases in sales revenue for a company. And with PayPal being up 10%, website visits, traffic, more eyeballs on their site, more people sending money to and from places using PayPal, I think it'll show in the revenue. But after this earnings cycle is over, I'll share those results with you guys. All right, so back to PayPal and their earnings. Got a little sidetrack there. They have an estimated EPS of $1.12 a share on revenue of $6.89 billion. So those are the stocks I'm watching for tomorrow. Exxon Mobil, Google, Alphabet, sorry, AMD, and PayPal. Those are the most exciting to me for tomorrow. All right. I hope the market rally continues as we kick off the month of February. And I hope we're not in a dead cat bounce. And again, nothing to do with an actual cat, just a technical phrase for the market. Okay, if you found this video to be helpful, informative, actionable, really, if you found something in this video to be actionable, then click the like button. That's what YouTube know, that you think there was information actionable in this video. And then take the URL and share it wherever you can. Twitter, Facebook, anywhere. That lets other people know that you thought this video was actionable. And then third, click the first link in the description. We have a special running. It ends tonight at midnight. All tiers, no matter which one you choose, get our most recent top 10 value stocks, top 10 growth stocks, top 10 dividend stocks, and top 10 momentum stocks. Our most recent updates. So do those three things for me, and that will help the channel out a lot. It will help us to continue to grow. It will help us to expand and do new and fun things. We've got some good plans for the channel coming up. 2022, whether the market's green or red, up or down, sideways, flat, it doesn't matter, because we'll be here helping you along the way. Okay, ladies and gentlemen, I want to thank you all. I'm just checking here to make sure we've got everything covered, and it looks like we do. All right. Okay. Thank you guys so very much for joining me, and I'll see you in the next video.